Hello and welcome to Finance RM. In this lesson, we will talk about real estate. So, firstly, real estate as an asset class. Real estate is not just land and buildings, it is a multi-dimensional asset combining physical, utility income potential, and capital appreciation. Unlike stocks or bonds, which are purely financial instruments, real estate has a tangible component that directly supports human activities such as living, working, and producing. Core functions of real estate include consumption, providing housing, shelter, and workspace; productions, which enables industrial and commercial activity; store of value, which retains purchasing power over long horizons, especially against inflation; collateral role, which can be pledged for loans such as mortgages, development, and financing. Then there's unique characteristics which can be compared to other assets such as a fixed location and the scarcity, the dual return streams, which provides ongoing cash stream and rents and capital appreciation, as land is finite, especially in high demand urban centers, and property cannot be moved. Its value is tied to geography, accessibility, and its surrounding infrastructure. High transaction costs, as brokerage fees, taxes, legal costs make real estate less liquid; and cyclicality, as property markets follow economic and demographic cycles. Categories of real estate and their uses. So, firstly, real estate is very diverse as it has many things such as the residential, commercial, or private, and with different sub-markets serving different sub-functions, each category carrying its own drivers, risks, and investment profiles. Residential real estate is single-family homes, condominiums, apartments, and vacation properties, which is primarily purchased for shelter but also for rental yield. Its demand is tied to population growth, interest rates, and household income. An example is buy-to-let apartments in urban centers generating rental monthly income. Commercial real estate, or CRE, includes office towers, shopping malls, retail stores, and hotels. They're driven by business activity, employment growth, and consumer spending, as tenants often sign long-term leases, providing predictable income. Industrial and logistics real estate, as warehouses, factories, and logistics hubs, and criticals in global supply chain and e-commerce growth. An example is Amazon fulfillment centers leased for decades. Agricultural and land investments, as farmland, ranches, timberland, undeveloped plots. They generate yield through crops, livestock, or future development. Investors often hold raw land for appreciation once infrastructure expands. And specialized real estate is hospitals, data centers, senior living facilities, and schools. The niche but growing sectors often requiring specialized management. Indirect vehicles, or REITs, real estate investment trusts, are publicly traded or private entities pooling investor funds to own real estate portfolios. They allow investors to access real estate without buying property directly and provide liquidity and diversification compared to direct ownership. Now, financing and leverage in real estate. A defining feature of real estate is investing is leverage, the ability to control a large property with relatively little upfront capital. Mortgages, standard tool for individuals and businesses. Loan to value ratio, or LTV, determines how much debt is used. An example, with a 20% down payment, a buyer can purchase a $500,000 house with $100,000 equity and $400,000 debt. Commercial loans, which are more complex than residential mortgages, include balloon payments, floating rates, or covenants tied to rental income. The leverage effect, if positive, if a property appreciates 10% while debt remains fixed, equity return is magnified, and is negative if rent declines or interest rates rise. Debt servicing can erode profits. Creative financing structures, as real estate syndication, multiple investors pool funds for large deals. Crowdfunding platforms allow small investors to participate in commercial projects. And sale-leaseback agreements and arrangements, as companies sell buildings to investors but remain tenants, freeing up capital while retaining operational use. Debt metrics in real estate is the debt service coverage ratio, or DSCR, which measures the property income relative to debt payments. As DSCR is greater than the 1.2 usually required, the capitalization rate, or the cap rate, indicates return based on net operating income relative to property price, and the internal rate of return or long-term profitability measure is of factoring in financing and appreciation. Valuation techniques and performance metrics is that valuation in real estate is complex and multi-method. Since properties are unique and illiquid, investors and lenders rely on several approaches, such as sales comparison approach, compares recent sales of similar properties, works best for residential homes in active markets. And an example is if there are nearby homes sold for $250,000 to $270,000, a similar one will be valued in that range. Income capitalization approach values property based on rental income with the formula as the value is the net operating income divided by the capitalization rate, where an example is a building with a net operating income of $1 million and a cap rate of 5% is worth $20 million. Discounted cash flow, or DCF, is project's rental income and eventual sale value discounted back at required rate of return. It's very useful for commercial properties with varying leases, and its cost approach is property value is the land and the construction cost, take away the depreciation. It's best for newer unique properties like hospitals or schools, and key performance indicators or KPIs are the net operating income, gross income, and operating expenses. The cash on cash return as annual cash flow versus initial equity investment, and occupancy rate with the percentage of space rented versus vacant, and the yield on cost as the net operating income relative to the total development costs. Real estate investment strategies. Investors can approach real estate with different strategies, each suited to varying risk profile, time horizons, and capital levels. Buy and hold, which is the rental strategy, is purchase property and rent it out for steady income. Works best in growing urban areas with rising rents. An example would be owning an apartment building that produces 6% annual yield. Fix and flip, which is buy undervalued properties, renovate, and sell quickly for profit. High risk, relying on market timing and renovation skill. The buy, rehab, rent, refinance, repeat. The cycle where investors build equity by improving properties, refinance to extract cash, and reinvest in new properties. Commercial development as large-scale construction of malls, offices, and hotels, and requires substantial capital, long timelines, and regulatory approvals. Real estate syndication and funds as pooling investors and capital to access larger projects, and allows passive investors to gain exposure to professionally managed assets. And global diversification with REITs as investors can hold shares in REITs specialized in data centers, healthcare, or global properties. So, next, moving on to the speculative land banking, as buying raw land on the edge of growing cities in anticipation of future development is a good idea, as well as high risk, long term, often tied into zoning and infrastructure and expansion. So, the foundations of real estate as an asset and its unique and valuable categories of real estate and their uses is a breakdown of major types: financing and leverage in real estate, mortgages, debt structures, and effects of usage. Then there can be valuation techniques and performance metrics, how properties are priced and measured. Real estate investment strategies, which are practical approaches for different investor things. And legal, regulatory, and taxation aspects include the freehold versus leasehold, the title deed, the zoning laws, governmental and legal approvals, taxation on real estate, eminent domain, compulsory acquisition, foreign ownership restrictions, taxation of real estate as transaction taxes, stamp duty, registration fees, capital gains tax, rental income tax, and depreciation benefits will all apply. Legal risks in real estate will include the title disputes, tenancy laws, tenant protections, and environmental regulations, as well as cross-border real estate. And real estate legal structures will include individual ownership, partnership, REITs, trust, and corporate. Thank you, and remember to be smart, stay smart, and achieve your financial goals. Don't forget to drop a like on the video and subscribe to the channel, and comment any questions you have or advice for the channel.